Here's the Pimco take on all of this. Tiffany Wilding writing the following. In our view, a 25 basis point cut remains the most likely outcome. However, we wouldn't rule out a 50 basis point cut. Recent US economic data have been somewhat more encouraging, but the broader growth trends in a number of sectors still look notably weak. Pleased to say that Tiffany Wilding joins us now from Newport Beach, California. Tiffany, love to get your thoughts on these kind of things. Just walk me through your thinking 2 weeks out from that Fed decision.
Yeah, well, thanks for having me. Well, I mean, as I said, we've had some more encouraging economic data reports more recently. Everybody's citing the payrolls. We also had a bit of a stronger inflation print with the CPI print. But if you look kind of more historically or more of the last couple of months, we've seen a pretty weakening trends in a number of sectors, as I said. So manufacturing, although maybe it looked a little bit better, we're actually in contraction. So the numbers that came out of the Fed a few weeks ago actually suggested that we contracted in terms of our manufacturing output in the first quarter and did so again in the second quarter. You look elsewhere in the economy, the export sectors are also notably weak. Structures investment, these are interest rate sensitive sectors. It looks like the economy actually is reasonably interest rate sensitive. They're also weak. We have parts of the structures investment in the U.S. That are contracting on a notable basis. So I think the Fed is probably looking at all of that data. They're probably weighing that against the fact that the consumer, and this is something that we've also been very focused on, the consumer looks pretty stable. Retail sales, as was suggested, was notably strong. Consumption, we think, is going to be 4% in the second quarter. That's a pretty big rebound versus the second quarter. But the bottom line is there is weakness. That weakness in the economy could start to spill over. I think there is that risk, could start to spill over into broader sectors of the economy more notably. So as John Williams suggested yesterday, academic research does suggest when you don't have a lot of room on your conventional policy rate to ease, as the Fed does now, given the real neutral interest rates lower, you do want to be more preemptive in your potential easing. You want to be early and aggressive, as they say.
So, Tiffany, just to explore that one step further, if they're emphasizing the limited ammunition they have now and the limited ability they have to respond to an actual downturn, how much credibility will they have if that downturn actually materializes?
Yeah, so that's certainly possible. It's certainly possible they could cut rates, and then you could see, additional negative shocks to the economy that ultimately do, increase the probability of recession in the U.S. and take us back to the zero lower bound. But I think the Fed is trying to preempt that. So they're really hoping, or at least, I think the folks that, as of June, and the SEP penciled in 50 basis points of rate cuts, those folks on the Fed, I think they believe that, there's enough downside risk to the economy. We're still okay, but we want to act preemptively now, to sort of buffer the possibility of those negative shocks so we don't go down to the zero lower bound and we don't have that increased probability of recession.
Tiffany, many investment calls are coming down to quite a simple question. Where do you think we are in the cycle? Simple question for me to ask, much more complex to answer. And where people come down on that answer typically gives me an idea of where they're going with risk assets. Where does Pimco come down on that particular question at the moment, Tiffany? Can the Fed achieve what they're trying to achieve, which is extend the expansion even further?
Yeah, I think it's certainly possible. Now, when we kind of look around, you're really kind of asking about our views on the near-term likelihood of recession. I think when we look around, I think the most likely catalyst for a recession is, a shock related to confidence or related to the ongoing trade tensions that the U.S. has vis-a-vis China and vis-a-vis its other trading partners. But when we look elsewhere, historically, the kind of things that have created a recession have been, Fed over tightening and or a buildup of risk in some part of the economy, that kind of irrational exuberance that has to unwind. And I think that, the probability that the Fed over tightens, now, especially since they're talking about cuts, certainly has gone down. And when we look at, certain sectors of the economy, there is maybe some frothiness in certain sectors of credit, et cetera, but ultimately we don't think that that's going to cause, a systemic shock to the U.S. economy. Although, again, I think it's reasonable when you have some deceleration in growth that the Fed would want to buffer that, and reduce that risk of a bigger shock by providing accommodation.